Hello everyone, and welcome to this video where we'll look at the current situation with, of course, the focus on economics and the markets. There's no need to talk too much about coronavirus. You are likely already aware of a virus that has been rapidly spreading around the world and may have a perception from the media of what it brings with it. Instead, let's look at what this means economically and for the financial markets. Economically, this virus is slowing down and shutting down entire economies. It all started in China at the end of last year. Factories needed to shut down for days or weeks, interrupting their production. Ports have been put under alert, slowing down shipping. Take into consideration that China is the factory of the world. This is why you should be especially careful about production data, manufacturing, industrial production, and especially imports and exports. Just such data from China reported recently has already come in very weak, and an economy like Japan is contracting quarterly at a 7% rate. But it has not stopped there. The virus is spreading around the world, from the Middle East to Europe to the US. People have cancelled travel plans, and events, sporting, entertainment, and professional, have also been put on hold. Millions of people have been affected in some way and need to change their lives, especially those quarantined and confined to their homes. You can just imagine what all of this means for the global economy. We still cannot measure the real impact of all of this together, as it all continues to unfold over the coming weeks and months. And while we believe this will come to an end eventually, something central banks and governments are already working on, it will certainly have a serious impact. That said, let's focus on what this means for the markets. The most obvious effect, a surge in volatility. Volatility is how fast instruments move. We recently added VIX, the measure of volatility in US indices and stocks, as a tradable instrument to our platform. Well, to put it in perspective, VIX is now trading at 54, having been at 13 no longer than 1 month ago. You can see just here, this is the chart of VIX, the first future tradable. Look at how low it was just 1 month ago and how high it spiked. Yes, it has multiplied by 4 in 1 month. If you haven't been trading for more than a few years, then these swings will be very new for you. But I can assure that even the extreme low volatility that we had before was not the norm either. So, here comes the news. Volatility, a high VIX, is a trader's best friend. Yes, these are movements that could take 2 or 3 months to see before, but now happen in probably no more than 1 week. Long-term investors might not like it, but for us as traders, being able to lock a profit of several hundred pips in just a few hours is a rarity. Of course, one must know what he's doing, being smart, fast, and especially humble. For a better understanding of this, you could have a look at an easy indicator that you can find in your own MT4, the ATR, or average true range. This is easier to read and understand than the VIX. It just shows the swings between the lows and the highs of the instrument. ATR on SP 500 had a reading of 27 pips on February 20th and is now at 160. Let's have a look at some Forex pairs. Euro-dollar. Here we see a long-term chart for Euro-dollar. And here, this one down, is the ATR. Well, Euro-dollar was moving 43 pips on that same day, the 20th of February, just here. You can see it here, around 20 pips. Now it sits at 133 pips. It's not 39, but 43 when I was writing at least, on average. This means that the daily average movement has been of 133 pips from the lows to the highs. On our pairs, let's have a look to dollar yen. Dollar yen, you can see it also without going down to VTR, the huge movement. And you'll better understand it here. Look where it was at mid-February. Just around 30 pips. And it has spiked to almost 200 pips, exactly 190. Simply put, this means that any potential profit or loss has increased anywhere from 3 to 5 times as much, depending on the instrument. Now, let's have a look at what you should consider in this new situation. Volatility is high and will stay high for weeks. Consider that even 30 is a high rate for VIX, and now we are at 54. There will be likely big swings for the coming weeks, and they could be either to the upside or to the downside. Just to have a look here in the chart of the dollar yen, you can see how, even if it's small, what a big green candle we had after some big falls. This is a clear example of this. Don't be surprised by a plus 4% followed by minus 5% movement the next day. Take advantage of this. This said, you need to model your exposure. If before you needed 5 lots for your strategy, maybe now just 1 lot may be enough. Reconsider your allocation according to these wider swings. Dollar yen, you can see in which a tight channel was moving and which huge movement is doing right now. So what we can understand is that trading now will be fast. This is a good time for day traders. You have the potential to lock in profit over a very short time. Don't leave positions open while being somewhere else if you can avoid it. And consider being fast in entering and exiting the market. Also, about stop losses. Random movements are wider, so don't place them too tightly, given their importance. Give your position a bit of breathing room. You can also consider moving them above break-even when your trade goes positive. This way, you can lock in a profit, even if the market then moves against you later. Remember that there are different types of asset classes. The yen, that we are seeing right now, and the franc Swiss are considered safe havens and strengthen when there is uncertainty. We have had big uncertainty lately. You see how dollar yen has fallen dramatically, and this means that yen is strengthening. Currency like Australian dollar, the Canadian dollar, the New Zealand dollar are called commodity currency and suffer when oil and metals go down. Here we see the chart of the oil, and as you can see, it has moved dramatically as well. So just let's move to this chart of the Australian dollar, and you can see that it has gone down steadily, also before that 20th of February when things started to go worse. The movement started before, when the oil movement started. And you see how big have been the movement lately. To be accurate, this Monday, when oil just dropped dramatically. And so the Australian dollar had huge swings from 0.63 to 0.66. You also know that gold is regarded as a safe investment during such periods. So think about the possibility of investing in it. Emerging market currency will be very volatile. This is dollar against the Mexican peso. I think there's not much to be said about this chart and the huge swings. You can lock in big profits, but be very careful. Volatility is extremely high. Finally, you have to remember that long-term investors don't like volatility, and so they will be absent from the market for a while, which means fewer bids, fewer buyers will be in the market. It will take time to all the markets to stabilize. In essence, these are exceptional times for traders, but it can be used to your own advantage, provided you do so with a plan and humility. Good luck and trade safe.